This Chapter 1 reviews the general characteristics of the commodities markets, including its main constituents and players, and analyzes some of the key characteristics of commodities and of commodity derivatives that make this asset class different from typical investments such as stocks and bonds. Commodities can be defined generally as items of value of uniform quality that are produced in large quantities by many producers, with items from each producer considered more or less equivalent. Commodities are typically broken down by traders and financial institutions into a number of categories, the principal ones of which are energy products, precious metals, industrial metals, agricultural commodities, and livestock. Each of these is further subdivided into smaller categories, as illustrated in the chart appearing below, which represents the breakdown of the former Goldman Sachs Commodities Index, now known as the S&P GSCI Index. The numbers indicate the weights within the index. You see here the subcategories for energy. Here are the subcategories for industrial metals. Here are the subcategories for precious metals. Here are the subcategories for agricultural items. And here are the subcategories for livestock. Key players in commodities include producers, end users, brokers, investment and commercial bank traders, and hedge funds. Commodities have also earned an allocation in many diversified institutional investment portfolios on the basis of their high long-term return, their suitability as hedges for unanticipated inflation, and their low correlation with other asset classes. And all this despite their high volatility and modest Sharpe ratio, a topic to which we return later. Investing in commodities can be implemented in a number of ways, including but rarely through investment in the commodity itself, via any number of derivatives, including futures, swaps, and options, via the shares of companies that produce the desired commodity, via mutual funds or exchange-traded funds that invest principally in commodities, via structured notes whose coupon or principal is linked to commodity prices, or if a broader allocation is desired to the asset class as a whole rather than to any individual commodity, via indices such as the S&P GSCI Index or the DJUBS Index, which has a lower allocation to energy products and is generally more diversified than the S&P GSCI. Returns from commodities have been quite high, as mentioned earlier, but have evidenced substantial volatility over the past 2 decades, as you can see from the graph appearing now, which plots the annualized total return of the former GSCI from 1970 to the end of 2007. We also mentioned that commodities have typically proven to have low or negative correlations to other financial assets, which has increased their diversification appeal to institutional investors in particular. Historical correlations for a 10-year period and a few other relevant figures are listed on the table appearing next in front of you. Here are the correlations. Much trading of commodities is done in either the spot or the short-dated futures market, where many of the usual trading strategies from other areas are used as well, but also some that are more specific to the essence of commodities themselves and have no parallel in other areas. It is also true, arguably, that drivers of commodity prices span a wider range than other asset classes, such as bonds or currencies, at least with regard to their ability to produce immediate and sizable movements in price. These include, for example, in the case of crude oil and refined products trading, the following: supply and demand, with relatively small increases in demand or declines in supplies influencing prices substantially. New oil discoveries, which are sometimes announced very suddenly and cause rapid swings in prices as traders adjust their views to reflect the anticipated expansion of production. Of course, this can be viewed as just another example of changes in the demand-supply equilibrium. Geopolitics, particularly in the Middle East and parts of Africa and Latin America. Refining outages, where the stoppage of production by one or two large refiners, even for a few days, again can quickly disturb price equilibrium. These can result from weather conditions, natural catastrophes, political developments, or labor strikes, among other causes. Technological advances, which may lower production costs or create new manufacturing and industrial processes that are less dependent on energy products. Environmental legislation and regulation, a factor of increasing relevance as more countries sign on to clean energy commitments. Economic factors, such as the recovery from the current recession and the continuing rapid growth of India and China. And finally, position taking by technical analysts, which may be divorced from fundamentals altogether, or may reflect some fundamentals but exaggerate them significantly. Trading strategies for commodities are numerous, as we have said, and deserve a module all on their own, which will be part of our dedicated set of modules for trading strategies across all principal asset classes. One particularly important strategy, however, involves the so-called roll return, and will be described in detail in the next chapter after we have covered a few more basic topics. We now spend a few moments discussing the principal ways in which commodities and commodity derivatives differ fundamentally from FX, interest rates, and equities, which give rise to some of the more complex issues regarding their pricing, trading, and risk management. One important difference is that commodities, even involving the same general asset class, still come in a variety of different grades and specifications, all of which must be defined carefully to eliminate any doubt regarding the appropriateness of the product delivered under a spot, forward, or option contract. Thus, it is not enough to specify in a confirmation that the forward seller will deliver to the forward buyer 100 barrels of crude oil on July 1, 2010. The confirmation will stipulate the grade of crude that is deemed acceptable, including key specifications regarding sulfur content and gravity that make one grade materially different from an inferior grade that would not be acceptable for delivery. Delivery location is a second important characteristic of commodities trading. Since the distances involved and the cost of shipping large quantities across these distances means that the price at one location can differ substantially from the price at another. The world of securities and currencies does not share this characteristic, since a common share of IBM is just like another common share of IBM, and delivering it usually means clicking the mouse rather than loading tons of containers on a transatlantic freighter. With so many grades available for a particular commodity, the market has had to choose a few representative grades and delivery locations for purposes of futures and options trading, and for inclusion in baskets and indices. For crude oil, for example, West Texas Intermediate, WTI, Alaska North Slope, Brent, and Dubai are among the more popular representatives. In turn, this gives rise to significant basis risk for end users seeking to hedge their purchases or sales. A consumer that purchases Nigerian crude but finds himself obligated to hedge the purchase price using Brent futures exposes himself to basis risk, which can only be reduced in part by examining the price relationship between the Nigerian and Brent crudes and adjusting the hedge strategy to reflect this difference. A third difference is that pricing models for commodity price movements often contain an assumption of mean reversion. That is to say, that periods of steady price increases in real terms are followed by a reversion of the commodity price downward towards a long-term equilibrium level, and periods of steady price declines are followed by a reversion of the commodity price upward towards this long-term equilibrium level. The reasons for this assumption are twofold. In the case of price movements that reflect external events, such as weather conditions or geopolitical developments, it is normally assumed that the event eventually passes, so that the pressures brought on the market from it recede after some time. More generally, even when the external event does not recede after some time, producers will alter their production to fit the new level of prices, with high prices incentivating marginal high-cost producers to join the fray, and low prices forcing them to reduce output. A similar pattern of mean reversion is generally assumed for interest rates, incidentally, which have a tendency to oscillate over time around some long-term equilibrium level. But the cycle for mean reversion in the case of commodities is commonly assumed to be substantially shorter than for interest rates. All this contrasts with models for equity and currency prices, which are said to follow a geometric Brownian path, or using more familiar language, to follow a random walk in which the percentage change in the price on any day is completely independent from the previous history and entirely unpredictable, no matter how carefully we examine this history. You can probably see that this key assumption influences the pricing of options in particular in significant ways, since it causes long-term volatility typically to lie well below short-term volatility. More particularly, it has a strong effect on the pricing of options that are substantially out of the money, since the probability of large price movements for mean reverting assets may differ substantially than for ones that follow a geometric Brownian process. Interestingly, the effect may be to increase or decrease the option price relative to a comparable option under a geometric Brownian process, depending on whether the mean reversion effect would pull the commodity closer to the strike or further away from it. A fourth difference is that commodities in most cases are important raw materials in the manufacturing or consumption process, so derive their value not from any underlying wealth that they represent, as in the case of stocks and bonds, but in and of themselves as the very items that create this wealth. This has important consequences to the pricing of the forward curve for commodities and results in many of the arbitrage relationships that are taken for granted in deriving forward and option prices, simply not applying with the same rigidity in the case of commodities, for which ownership today versus ownership on a future date can have quite different values to the consumer. We examined this last point in greater depth, and recall first the basis for calculating the forward price of a currency or equity. For currencies or equities, forward prices are derived from the well-established no arbitrage relationship that links forward prices to the spot price and the cost of carry. Thus, for a 1-year FX forward, we have forward equals spot times 1 plus the term currency interest rate over 1 plus the base currency interest rate, where TR is the term currency interest rate and BR is the base currency interest rate. And for a 1-year equity forward, we have forward equals spot times 1 plus RFR over 1 plus div, where RFR is the risk-free interest rate in the currency in which the stock is quoted, and div is the stock's dividend yield. Except for bid offers, These two relationships necessarily must hold for currencies and equities. Otherwise, it becomes possible for an arbitrageur to exploit them and generate essentially risk-free profits according to well-established arbitrage strategies. For example, if the one-year rates in euro and dollars are 5% and spot is 1.4, while a bank is quoting the one-year euro forward at 1.42, an arbitrageur exploits this by borrowing in US dollars at 5% for 1 year, converting the dollars into euros at the spot rate, investing in euros at 5% for 1 year, selling to the bank the proceeds of this investment against dollars under a 1 year forward at 142, and finally repaying the dollar loan plus interest from the dollar proceeds under the forward. In so doing, he assures himself of a risk-free profit of around 2 cents per 1 euro of notional. In turn, this pressures the quoting bank into lowering its quote of 142, eventually pulling it down to 140, where the arbitrage becomes impossible. A parallel strategy exists for equities. Attempting to replicate this for commodities raises two problems. First, the party holding the commodity and awaiting the delivery date under the forward must store it in a secure place and insure it during that time, which raises the cost of carry and necessitates an adjustment in the formula to reflect these additional costs. And two, perhaps more importantly, any end user that genuinely needs the commodity for use in its industrial process will include in the cost of carry under a forward purchase the very real costs of having to shut down his factory or plant if he does not have the commodity available for immediate use. To illustrate, a spot price of 100 versus a 1 year forward price of 95, continuing to assume a 5% interest rate, would suggest that the industrial concern should simply shut down his plant for 1 year, purchase the commodity under a 1 year forward contract, and use the $100 he does not need immediately for spot purchases to earn 5% interest over this time period. He would find himself in 1 year able to resume operations with crude that has cost him only $95 and with a residual $10 in his pocket from the difference between the 105 yielded by his 1 year investment and the 95 he pays for the crude under the forward. But during this time, of course, he has also foregone the profit he could have generated by continuing operations. This foregone profit representing, in a sense, an additional cost that needs to be factored into his analysis. If in the formulas above we define S as the annualized cost of storage in percentage, I as the cost of insurance, again in percentage, and Y as the foregone profit, yet again in percentage, then our equation for the relationship between 1 year forward prices and spot prices becomes forward equals spot times 1 plus S plus I plus RFR divided by 1 plus Y, which is more typically written in continuous notation as forward equals spot times e to the power RFR plus S plus I minus Y. The letter Y is used to denote the term convenience yield, the normal phrase among practitioners for designating the benefits of having the commodity available immediately versus at some point in the future. The difficulty this presents is that the convenience yield varies significantly from user to user, since it depends on the production process, cost structure, financial leverage, and a number of other factors, all of which vary from one consumer to another. The same, but to a lesser degree, is true of the storage and insurance cost components. This critical input that is so variable from one participant to another causes severe distortions in the ordinary spot-forward relationship and has no parallel among stocks, bonds, currencies, and the like. A final factor that distorts the classical spot-forward relationship is the difficulty of borrowing crude and many other commodities to take short positions. Returning to equities, we assume that a stock that pays no dividends trades at 100 in the spot market and at 98 in the one-year forward market, while the risk-free rate continues to be 5%. The arbitrage strategy simply involves 1. Borrowing the stock for 1 year. 2. Selling it immediately for 100 and purchasing it 1 year forward at 98. 3. Investing the 100 for 1 year at 5%. And 4. Spending $98 from the proceeds of the investment at maturity to take delivery of the stock on the settlement date of the forward, leaving in the arbitrageur's pocket an amount equal to $7 minus the cost of borrowing the stock for 1 year, a number usually in dozens of basis points or at most a couple of 100 basis points. As always, this pushes forward and spot prices closer to the equilibrium values dictated by the formula. With many commodities, however, the ability to borrow the commodity may be severely limited, or may be so expensive as to make the exercise unprofitable. To a large degree, the high cost of borrowing commodities stems from the same reality we discussed a moment ago. Having the commodity immediately available is more valuable than having it in the future. So even those entities that may have an excess of the commodity in inventory will be reluctant to lend it out, absent an unusually strong incentive to do so. A consequence of the convenience yield is that the forward curve for commodities can often be inverted, particularly for commodities that are difficult to short, such as energy products, and those whose use in the industrial or manufacturing process is essential and thus for which producers will pay a premium over forward prices to assure immediate availability, as explained above. Crude oil in particular often evidences an inverted forward pattern, which is known among traders as backwardation, in contrast to an upward sloping forward curve, which is said to be in contango. Research also suggests that backwardation is a more logical pattern for commodities than contango, because producers are under greater pressure to hedge revenues from commodity sales than consumers are to hedge costs of purchases. The argument here is that for a producer, the commodity in question typically represents a substantial percentage of his revenues, in many cases close to 100%. So abrupt declines in prices can devastate the company's financial well-being. While for most consumers, this is only one of several principal cost items, whose significance in isolation is therefore not as severe as for producers. In the next chapter, we will examine an important trading strategy to take advantage of curve backwardation, known as the roll strategy, that has generated excellent returns for users over many years in the past. But we bring chapter 1 to an end right here.